Hello, and welcome to Need to Know, your weekly investment podcast brought to you by the experts at Coutts. I'm Sarah Muir, and I'm joined as always by Coutts CIO Alan Higgins, plus special guest this week for our US earnings special. It's Coutts US equity expert Howard Sparks, a friend of the podcast. Now, as we've mentioned on recent introductions to Need to Know, of course, we're very mindful of the tragic events that are going on in the Middle East at the moment. But we feel it's very important to leave the discussion of geopolitics to those who are far more qualified than us. So what we're going to focus on every week, as we do every week on Need to Know, is the three things investors need to know. Now, whether that's for the immediate week ahead or looking at longer term trends. And obviously with Howard on, we're going to be looking at earnings season this week. But before we get to that, a couple of things to catch up with you, Alan. First of all, you shared with me the link of, now I need to pronounce his name right because I spent far too long in Germany, Byron Wien. He died recently, didn't he? And I know you had some thoughts you wanted to share on Byron Wien.
Yes, really inspirational character. I worked with him at Morgan Stanley. Okay, he was very senior at Morgan Stanley, then went to Blackstone and, continued to work very rigorously late on his career. So, I mean, one of his genius acts was coming up with the 10 surprises every year. I think we should do a little bit about that. And by that, it was very subtle, because what he would do is come up with a surprise. I don't know, I'll think of something for next year, something like he would look at something which the markets really don't predict, but he thinks there's a higher probability than the market predicts. So I don't know, US bond yields, which are currently 5, falling below 4. Most people are not predicting that. But he would give a higher probability on it and go through the reasoning why he'd give it a higher probability. So they were not ridiculous surprises. And they were really good and thought-provoking in terms of your portfolio. What if? So I think we should do that. But also what is really popular and all over the internet is basically lessons for life.
Yeah.
20, you can Google it. I'll just mention one, for example, which resonates with me briefly. Network intensely. Luck plays a big role in life, and there's no better way to increase your luck than by knowing as many people as possible. I mean, he goes on to talk about lectures and sending books and great things like that. But what an amazing guy, what an amazing career. And to pay homage to him, later on, Sarah, we'll do maybe, if not 10 surprises, 3 surprises for the next year.
Yeah, definitely. Yeah. And for those of you that perhaps don't know Byron Wien, as I didn't until I was prompted to go and look him up by Alan. Read about him, read through what his 10 surprises were for this year, read through his life lessons. They're really, really interesting. But it's also, I guess, passive versus active. We talked about this last week, and you were talking about how many active managers failed to beat their benchmark. And you had a little bit of a revision to that number, I think, didn't you?
So a revision to the number, and also one person got in touch with me, only one, but made a very good point. It basically said, so the data is this, and this is from S&P. They call this SPIVA survey. They do it very well because they take out survivorship. What does that mean? So a fund that's really underperforming, obviously no longer, and was closed down 2 years ago, is no longer on databases today. S&P have put it back in, if you like. That's a bit of can be a double-edged sword in the sense that it could be a real terrible doggy fund, that doggy technical term, that no one would have invested in. But also it's very pure. But anyway, the numbers are this: over 5 years, 87% of managers in the US underperform. And so someone asked me, okay, you made the big call. It's now time for active. What does that actually mean? And that was actually quite thought-provoking. Does that number fall below 50%? I don't think it does. I still think it's incredibly challenging. So does that mean Coutts completely turns its back on passive? No. It's completely challenging. But does that number fall towards 50 to 60? I can see that. And we can go through reasons we gave reasons for that last time. And maybe we'll have an interesting debate with Howard later on active versus passive also.
I think that's going to be a topic we're going to be revisiting towards the end of this podcast. And then finally, it is a bumper week for central banks. I mean, I get the sense that other than Japan, which is intriguing, it's a little bit, there's nothing very exciting to sort of expect from the Bank of England or the Fed this week?
No, both of them are in table mountain mode, hold rates steady and hope that nothing breaks. There's a realization one, inflation is falling and they've done a lot. So yes, that nothing there. But Japan is intriguing. They're really fighting an old battle, trying to keep bond yields interest rates very low, but in a very targeted way, but also trying to protect the currency. Something has to give there. What they've done is basically loosened again, but not enough in my mind. But I think that we'll need to do that in more depth another time, Sarah.
Yeah. Okay. All right. Well, that sure we'll be revisiting that. Okay. So as we've got two of you on, we are still stuck with not stuck. What we do is we have three things. So Howard, I'm giving you two. Alan's going to get one. So Howard, what are the two things from you we need to know about US earnings season?
Well, thanks for having me back on. It's an absolute pleasure to be on here. Q3 earnings were great. That's the first one I'm going.
Okay.
But But
there's a big but, isn't there?
The investor reaction has been pretty awful, and I might dig into some of the reasons why that might have happened. And then, secondly, let's have an update on my favourite and your favourite film, The Magnificent Seven, not just of the film, of the stocks. And that's my two things.
Okay, brilliant. Okay, and then Alan, what's your one takeaway then from US earnings season that you want to bring to our attention?
I want to be a bit more longer term, but having said, because Howard's mentioned the Magnificent Seven, we'll have to let's have a discussion about the Magnificent Seven in the context of active versus passive, because the Magnificent Seven, Magnificent Seven plus Berkshire Hathaway make up 30% of the S&P 500.
Yeah.
So I'd be really and that's been obviously really challenging. Be interesting on his thoughts there. But I want to talk about earnings, and I want to talk especially about this theme that analysts are over optimistic, and I'll put that in a longer term context because you hear that all the time. Analysts are too optimistic.
Okay, all right then. Well, back to you then, Howard. So basically, earnings season, it's Q3 earnings season. I mean, we say this about every earnings season; they're always greatly anticipated. But how is Q3 earnings season looking so far? We must be fairly close to the end of it now, aren't we?
Yeah, we're, I guess, about 2/3 the way through, enough of a way through to have an idea about what's happening and what the key messages are. Although a lot of consumer companies, because of where Christmas falls, they kind of tend to have a January year end. So as a result, they're still to report. But still, I mean, on the face of it, when you look at it, we've seen 79% of companies in the US beating expectations. So normally that number's around about 65. So on the face of it, it's been a very good earnings season, and we're now on course for 2% earnings growth year on year. I remember over the last 3 quarters, we've had negative earnings growth year on year. So we're coming out of this trough back to positive earnings growth, which is should be good for markets. But digging beneath the surface of that, sales, if you look at just the top line, so sales and revenues, we've only seen 47% beats compared to expectations, and that's actually below average. In Europe, actually, it's even worse. I think about 35%, but let's leave Europe to one side. And the other thing that was striking, I got this from Savita at Bank of America, Merrill Lynch. I know you've mentioned Savita before, the strategist there. They look at mentions on company transcripts of weak demand. So that they, as you know, when companies release results, they obviously have an accompanying statement that they read out and have an analyst call. And what the boffins at Bank of America have done have counted up all the times that weak demand gets mentioned, and those mentions are kind of back to COVID and also back to 2009 levels. So something is happening, right? And so I guess that's perhaps the reason why we've seen such a negative reaction.
Are they seeing weak demand in the outlooks, or are they in the guidance, or are they seeing weak demand now? They've seen it in Q3.
Well, they've seen it going into this quarter and going into next quarter. I think that what's happening is that often analysts are kind of extrapolating what they're hearing. Any kind of mention of weak demand, whether or not it's past or to come, has set the cat amongst the pigeons a bit in terms of the some of the investor reactions that we've seen. In terms of the official kind of forward guidance, there's very little to gauge from that, really. It's very difficult to see any kind of clear patterns. One thing that's actually kind of coming through is a lot of consumer spending is still pretty robust. We've seen, particularly in the kind of experiences rather than things like hotels, cruise lines. So we had upgraded guidance from the likes of Hilton and Carnival Cruising. So some things are still positive, but meanwhile, other areas like, I think, chemicals, for example, was an area where we saw some weakness in guidance. But yeah, it's I think that's kind of just taking the edge off earnings season, and I think it's kind of interesting that how have these companies been able to beat earnings when sales have perhaps been a bit disappointing?
Yeah.
I think does come down to what I like to call levers. I think great companies have ways of making that earnings number. So they've got levers they can pull. One of the greatest, I think, is Apple. Sometimes there's so many people coming out and say, well, surely iPhone sales are weak, surely iPad sales week, no one's buying Macs anymore. So how are these companies, or how's Apple beating earnings numbers? Well, it can just do it, you see. So I think that's just great companies, and I think that a lot of kind of great companies have done that.
Okay, before we get to the bit which I want to sort of dig down with you about, which is market reaction to what's ostensibly being actually quite good reports. I did actually read, I saw that McDonald's had reported their revenues were up 14%, which I suppose plays into that experiential kind of sector that's doing well. And a lot of this is about a sort of, I guess we're still talking about a resilient US consumer, but is this sustainable? Is this all being spent on credit cards? I mean, what's the guidance going forward for this consumer demand? Do analysts see this as sort of continuing, or do we see this? I mean, that you talked about the fact that weak demand was mentioned a lot. Are we going to start seeing that then?
It's so difficult to say, isn't it? I mean, it's when we look back at the GDP number, I think the surprising thing was consumer spending was so strong. I think we so many strategists, analysts calling the death of the consumer, saying that all this savings built up over COVID has finally been extinguished and spent, and so as a result, consumers are going to capitulate. But then Taylor Swift goes on a tour, and everyone's buying $1,000 tickets.
Yeah.
and Barbie Oppenheimer. Alan,
she's officially a billionaire now.
Yeah,
we've talked about the concert effect. I think that's absolutely right, and it's interesting what you said. I think a couple of things we've said before on here is about the consumer. We have to remember the 30-year mortgage issue in the States. So the US consumer typically has 3 to 4% mortgages locked in for 30 years. They don't suffer like many consumers do over here in Europe. So I'd put that in there. And I don't know what you think also, Howard, but very encouraging what you say about earnings. But don't you think we were just overdue a 10% correction? Like every year, nearly every year we have a 10% correction. And we've seen one. So, maybe it was nothing to do with that, just overbought. And a little bit overbought, especially in certain stocks.
Absolutely. I think that if you look back at, I know you look at investor surveys, the American Association of Individual Investors. That's a great one. So that just asks all its thousands of members, what's going to happen to markets over the next 6 months? Are they going up, they're going down, or they're going to stay the same? And it's just a phenomenal contrarian indicator.
Yeah.
And I think what we saw that back in July, August, that investors were just getting very positive. And I think that it's difficult to say, oh, well, one thing triggered it. But actually, it can be that just markets get slightly ahead of themselves, and that we have a reaction. As you say, it happens every year.
Before we get on,
sorry, so just to jump in to finish that, as we're down here today, I think we did mention this before. Michael Hartnett, he's got a bull bear indicator looking at the sentiment. Now everyone's bearish. I'm looking at it right now. It's a buy signal. So I think I think I'm with you, Howard, being a bit contrarian. Sarah, so sorry for interrupting you. Over to you.
That's right. No, I was just going to say, is it fair to say then that before we get to the Magnificent Seven, because we're going to look at that in a little bit more detail, but generally across sort of other sectors, is it fair to say that markets are just being a little bit more critical or a bit more discerning of companies that may have positive reports at the moment and may beat expectations, but they're maybe looking and thinking these are businesses that are vulnerable to sustained higher borrowing costs and potentially slower growth as well? Are they just getting a little bit more picky about the companies that they see are going to be good going forward, regardless of how positive their earnings reports are?
Definitely. I think we've seen that this quarter, that normally, in an earnings season, typical earnings season, when companies report better than expected sales and earnings, you would expect the shares to rise. And then conversely, any disappointments and shares get punished. Now, what we've seen this quarter, and Bloomberg have had some quite good data on this, is that normally when a company reports sales and earnings that miss expectations, shares tend to fall around about 3% on average.
Yeah.
This quarter, that move has been minus 5%. So it points to a much more discerning investor. So this has not been the quarter to disappoint. And we've seen that for a number of big moves. We'll come on to the Magnificent Seven, but we have seen a number of moves on companies that have disappointed. And the other thing, going back to this was some data again from Bank of America Merrill Lynch, was that they were saying that for those companies that beat, normally you would expect to see some a positive price reaction. Often that price reaction is there at the opening price, but by the end of the day, it's gone. Sellers have kind of come in and maybe looked further at the results and have sold off. And actually, they were saying that any alpha that you get from sales and earnings beats has disappeared by the end of the day. So it has been an earnings season when, for one reason or another, just investors just haven't been in the mood to reward winners and have been more inclined to punish those companies that have disappointed.
Okay, we're going to come on to the Magnificent Seven. There's one or two good examples, I'm guessing, amongst that group. So to summarise then, so far, sort of earnings season, we have seen more than average companies beating expectations. I think you said 79%, whereas the average is closer to 70%. And we've actually seen earning growth year on year of 2%, having had previous quarters of negative earnings growth. However, markets and investors are being put very, very tough on anybody that they feel is just not coming quite up to the mark, even though they might be sort of posting good reports. They're just perhaps not as good as they think they should be, or there's a little bit of disappointment there, and they're just being very critical, and they're not giving any quarter to any of these companies. Okay, well, let's come to the Magnificent Seven then. So what were the sort of the key? What did we learn so far from what we've seen? We've had some good and some bad, I think, haven't we, across the board?
Yes, that's right. And I'd like to go back to the film. I think we have to remember in the film that only 3 of them survived, right?
Oh, okay. That's a good point.
Yulbrunner, Steve McQueen, and Chico, the Mexican villager, I think, were the only 3 who survived. But I mean, I'm obviously, joking. But I think that it's one of those things that I do see signs of the Magnificent Seven as a group just beginning to splinter and beginning to crack. And I think you can see that certainly from where companies are trading relative to their 200-day moving average. And most of them are still trading above that level. And that is a well-used metric just to determine whether or not shares are still in uptrends or downtrends. But Tesla's well below, right? So I think after disappointing results, and I think they were genuinely disappointing results, shares were down 10%, and that's taken those shares down through the 200-day. Now, we've seen similar price reaction at Alphabet, although it's still in an uptrend, just about. So that's still good. But then if we look across to Apple, which has reports this week, then we are right at that 200-day moving average. So I think we just might be starting to see signs that these Magnificent Seven who've led obviously market returns just beginning to splinter a little bit, and perhaps this will turn into, I don't know, Magnificent Five, Magnificent Four. Who knows? I just think the signs aren't good.
Maybe it'll be down to Berkshire Hathaway, and who else might have in the top 3? Do you think?
Well, looking at earnings estimates, I mean, you can't get away from Nvidia, really. It's this company just continues to see massive upgrades to earnings because of what's happening in its with its chips, which are just so highly sought after for the compute that's needed in AI applications. So that's got to be a big favorite to be kind of one of the last to crack. But who knows? We have to wait and see.
And does it come down to then? So we've seen sort of some quite sort of negative reaction to, slightly disappointing earnings reports. Is that back down to, as it was perhaps last quarter, overconfident expectations coming into earnings season?
I think so. I mean, I think going back to what I was saying about very high levels of confidence during the summer, from an investor's perspective, we saw all of these companies performing pretty well into the print. So, yeah, maybe it's just a case. It's a combination of slightly, I guess, disappointing, or some areas of disappointment within the numbers, combined with over investor confidence. And I think and then obviously there's been other things happening in the market as well, which have kind of dragged markets down.
Okay. So for me, Howard, sorry to jump in there, Sarah.
Yeah.
Obviously, we haven't had Nvidia and Apple yet as we speak, but out of the 5, I think it's a 5, which you mentioned Tesla is amongst the worst. Which are the best earnings, would you say, in terms of the result and market reaction?
Well, I think lots of investors were probably expecting Microsoft to come out with a poor set of numbers, and I think that they've clearly surprised to the upside. I think the same to be said for Amazon as well. I think where maybe there were fears that at the heart of it, this is a consumer-facing company, and there were perhaps fears that they were going to come unstuck this quarter. But so I think that because I think expectations were perhaps quite tempered for those two companies. That's where you saw the positive reactions.
Okay, good to know.
Which brings us then to your final point, Alan, which was about longer term trends in earnings. I mean, a couple of things to pick up there. I know you want to say something about sort of dominance of the Magnificent Seven and whether that makes it harder or easier for active managers, but also, I guess, this point that that Howard made about the fact that sort of analyst expectations, are they too confident going into earnings season? I guess I know that's something you've looked at as well, isn't it?
Yeah, let's cover that first, because I've seen it time and time again for my career. And don't get me wrong, some of the analysts working on this, Howard mentioned Savita, and there's others, Marko Kolonovic at JP Morgan. He recently put a piece out saying earnings estimates for next year are too optimistic. And I get this, but look, they've been going since 1974. Going, what does that mean? That means a firm called IBIS originally basically collated all the analysts' forecasts and put them into a number since 1974. I think they're now by Refinitiv. And so we've got a long track record of analyst forecasts in aggregate. Typically, they expect 10 to 13% earnings growth per year, and then the actual result. And these are the numbers, very, very roughly. Over those circa 40 years, basically, it's longer than that, it's 50 years. Over those 50 years, only about 8 times earnings higher than what analysts expected. It's completely normal to somewhat disappoint. And why? Well, the long-term earnings growth is about 6.5 to 7%. That is the number for the US and globally. I know the FTSE 100, which is a very narrow index and special companies in it, hasn't been anything like that, but that's the number. And so ignore that. Yet the stock market's gone up. Why is the stock market going up? 6.5 to 7% earnings growth in aggregate is enough. Plus, you get a small dividend on top. I mean, that's what really drives the stock market, and in the long run. And stock markets are a lot more volatile than earnings. Okay, we're talking about a little bit of volatility in earnings here, and they do, of course, correct in recession and then rally back, just like we saw in 2020 to 2021. But so I wanted to mention that the resilience of earnings in the long run. Point one. And I guess, Howard, you've seen that time and time again as well, haven't you? But in terms of from a bottom up and aggregate about earnings forecasts, for example, the 2024, yeah, they do look optimistic. Does it mean the market's going to go down? What do you think?
Exactly. Well, knowing a lot of sell side analysts, I know how this works, right? So these analysts they're really good at forecasting what a company is going to earn next quarter or in the current quarter. There's so many other bits of data that they're excellent at kind of bringing in. So the accuracy level just really increases the shorter you get. But then if you ask them, well, what is that same company going to earn in 2 years' time? Then it becomes a little bit foggy. And these companies, they've been to see company management. When I don't see many company management teams anymore, but back in the day when I used to go and see managers or management all the time, these people are just incredibly persuasive. That's the reason why they've got to where they to CEO is they're very persuasive. They have lots of arguments about how growth is going to accelerate. Growth in a couple of years. Oh yeah, I know it's bad at the moment, but we've got this happening. We've got this happening. And analysts kind of write this all down and they plug this into their forecasts, and then lo and behold, in looking at their 2 years hence, they've got these very optimistic forecasts. So I think it's natural. It's kind of how the game works. And then obviously as those forecasts get closer and closer, then the accuracy level increases, and it's like, oh, hang on, we've been a bit too positive there. And you do see it every single year. Earnings estimates kind of from a bottom-up perspective, as you say, start off around about 10, they kind of finish at 6.
Yeah. Cool. Right now, Magnificent Seven plus Berkshire Hathaway, 30% of the index. It's been incredibly hard to outperform. I know Howard, you've had a great period recently. You've one of the rare managers to pick Nvidia. But what's your take on this active versus passive? I mean, you have to concede it's been tough, right? But now with such concentration, and by the way, before you answer that, because it is also the 20-year anniversary of the equally weighted S&P 500 index. You know that, yeah? You know that index, yeah?
I didn't know it was 20 years old, but yeah.
20,
okay.
But it's very simple to understand. Instead of Apple having, what is Apple, 7% or something of the index right now?
I think it's a bit more than that, isn't it?
Is it more than that now? My God, instead of these crazy weightings, crazy because it's an amazing company, we do know that, you basically just equal weight all 500 stocks. Anyway, these are the numbers to show why it can work. Over 20 years, and I recognize this is a very long time, the equal weighted have returned 11.5. S&P 500, 10.3. That's been a very good period. But of course, in the last couple of years, the equal weighted has been destroyed by the Magnificent Seven. So look, is it a chance for the equal weighted and active management to come back? Do you agree with my bold claim? It's time for active, or what do you think about it, Howard?
Yeah, I would take issue with this idea that you can say that because more stocks are outperforming, that means that it's easier for active managers. I would say that actually, in my experience, the times when I've performed best has been in times when market performance has been a little bit narrow, has been focused on a few areas, because then as active managers, then you can look to kind of overweight those areas to find more companies that are exposed to those kind of themes. And then as a result, becomes easier to outperform. When all kinds of companies are outperforming, and this is often during kind of the rebound from a major market correction or a major economic event or something like that, then sometimes you just get left behind as an active manager. And I think the best active managers tend to be very good at preserving capital. So when markets do have those downturns, then they can pivot towards those areas which are much more resilient. And we saw this a couple of years ago. So does it make it more likely that active managers are outperforming when that dispersion is wider? I would kind of take issue with that. The other thing where I would
Let me jump in while you're thinking. It's great to have a debate. I think that's good. But there's only one Howard Sparks. But no, but being serious, I wonder, because you formally embrace momentum into your investment approach, right? Maybe
Yes.
you could say not exactly how you do it, but and maybe that's the problem with the active management industry. Not many do. Maybe you can just describe momentum and also, intriguingly, theories why momentum works.
Yeah, well, I mean, why? Not sure.
What is it first? What is momentum?
If you look back statistically, companies that have performed well over the last, say, 6 months tend to outperform those companies that have done badly over the last 6 months. Share prices tend to trend, right? This is an important idea. Stock movements aren't completely random. I know there's this whole idea of efficient markets and it should be impossible, but to be honest, markets move in directions, uptrends, sideways, or downward. And I think investors, you're right. I think momentum just hasn't been as embraced as statistics say it should be.
Yeah.
Is it just about then momentum trading then, in simple terms? Is it about following a positive trend? This is the direction of travel. We're going to get on board with that direction of travel. Is that that's probably a bit of an oversimplification, but that is essentially what we're talking about.
Definitely. That's right. And then if you look at the flip side is mean reversion. So this whole idea that what goes up, what's been strong, inevitably will sell off. And I think that certainly works, as me and Alan have spoken about in other markets, particularly in bonds. that's a really good strategy, isn't it, Alan?
In credit in particular, credit is very mean reverting. But look, the academic evidence supports you that momentum works. But I think what I would say is, going back to the numbers, just a reminder, 5 years, 87% underperform. I don't think, I can barely think of an active manager that formally incorporates momentum, apart from yourself. I mean, they'll talk about it, but they don't formally incorporate it because, let's face it, it's a little bit embarrassing. Yeah, we're buying it because it's gone up. Let's be honest. It's as simple as that, right, Howard?
It is. The amount of clients who don't want to buy things that we've recommended because they've gone up a lot. Now, it is a kind of a little bit embarrassing, and I don't care. I'm embracing it at this stage.
Go with it. Take it on. It's work for you, Howard. So I think that's fine. Now, okay. So I think I'll take what you say on board, and I do not know what you mean. Like a rally of a trash can be really tough coming out of a recession. But I go back to the data, and even we can debate about the survivor bias and whether that's a good or bad thing. It has been challenging for most active managers. So I'm going to stand by my call. A comeback for active, yourself included, of course, where you were there already.
If I can just jump in, there was one other point I want to make. I think that where I do understand that active managers can struggle is when you've got large caps. I mean, obviously, when I said about narrow market performance, sometimes when the mega caps really perform well and leave the market behind, these kind of situations are quite rare. And I think it can be difficult for active managers to outperform in that scenario. I think so many market professionals, particularly on the buy side, they have expertise in the mid cap and the small cap space, and these companies they know very well.
Yeah,
it just does make things incredibly difficult when you see such underperformance of those kind of areas. But I would still stand by that. In a normal environment, taking out of that large cap effect, if there's areas of the market where the music's playing, active managers can just rotate into those kind of areas. And when there's fewer areas to look at where the performance has been strong, in my experience, it's kind of been easier to outperform in those kind of environments.
Yeah, I'll just end on one point, quite almost a humorous point, but I've never seen an active manager overweight Apple. I've seen plenty of active managers overweight Microsoft, but overweight Apple, you're saying it's bigger than a 7% weight. I'll call out two. One's a journalist, Ian Cowie of the Sunday Times, who writes very well. We'll tag him in, maybe get him on here even one day. Because he reveals his personal portfolio. And the other one, of course, is Warren Buffett. But he bought into Apple really late, but bought into such big size. But yeah, so I hear what you say. When the mega caps, like Apple, the poster child of the mega cap, really performs, it can be really tough. You've got to have so many good winners, and not many people have picked NVIDIA. And I think on that, Sarah, I think we should stop.
I think that's it. I think I'm able to get a word in edgeways again. It's fascinating listening to you two chat away. So essentially, then we're back to this discussion about active versus passive, and whether when you see a concentration that we're seeing in markets at the moment, particularly in US markets at the moment, whether that's good or bad for active managers. And I guess, the jury might still be out on this one, but it does seem to be that if you take the sort of momentum approach to investing, which is kind of riding the crest of that trend, it doesn't necessarily need to go against you. But I think we're going to come back to this because I don't think we've quite got the definitive answer on this yet. And as you always say, Alan, these are all theories anyway. There is no definitive answer, is there? I don't think.
Although, to be fair, momentum is a proven theory, but there's nothing to stop momentum not working ever again. That's the beauty of our investment industry.
Exactly. That's what keeps us on our toes. It keeps us with something to talk about every week on Need to Know. Thank you very much, Alan and Howard, for joining me today. A reminder that the views expressed in this podcast are not intended to constitute investment advice, are accurate at the time of recording, and are subject to change. Don't forget to check out the podcast page on Coutts.com, and of course subscribe to the podcast via wherever you get your podcasts. You'll find some additional sort of bonus episodes we've done recently. We did one on investor psychology, which is really, really interesting. Until the next Need to Know, bye for now.